Hi, everyone, and welcome back to another episode of Unlocking Venture Capital. I'm here with Ben from Highline Beta. Hi, Ben. How's it going?
Good. How are you?
I'm good. So, Ben, you're joining us today from Toronto, right?
Yes, Toronto. Absolutely.
Perfect. So, Ben, I knew Ben when he first wrote his book that I was vigorously studying when I was a founder, Lean Analytics. So, would love to learn more about first, why did you come up with this book, and how does it then transition you into the venture studio that we all know and love today?
Sure. Well, so we published Lean Analytics in 2013. Because I wrote it with a co-author, Alistair Kroll. We had wrapped up, or we were in the process of doing really what was a venture studio at the time, but we didn't call it back then. We called it an accelerator, an incubator. It's called Year One Labs. And the idea with Year One Labs was that was right around the time Lean Startup was emerging.
Yeah.
And so we were looking at how do we apply lean startup principles to the creation of new startups. And we ended up building and funding five companies. They all happened to be consumer businesses. That wasn't intentional. It just that's the way it worked out. One of those companies was acquired by Airbnb, that was a cool experience.
Yeah.
And but out of that, we were really trying to apply these principles. And Eric's book had just come out. It was, I would say, largely things were Eric Ries's book.
Yes.
Anyway, it was he was practicing this stuff, but it was still fairly theoretical to everybody else. You could read Lean Startup and say, wait a second, that makes sense, that makes sense, that makes sense, that makes sense. But we said, well, let's apply this stuff. And as we were applying it through Year One Labs, we wanted to take a more analytical approach to it and say, can we make this even more practical for people and get into the weeds of running experiments, testing things, measuring things. And so that's how lean analytics came out of that experience. Alistair had written a book before with O'Reilly. O'Reilly was in the process of working on an entire lean series. And so we ended up writing this book, Lean Analytics, focused on lean startup methodology and data.
Absolutely. And do you use these methodologies in your current venture studio, Highline Beta? And how do you do that with so many different kinds of startups?
We do. So I think, it's interesting. The book is now, 2013, so 12 years old.
Oh
Uh,
gosh.
Basically, yeah, 11 and a half years, right? So whatever. It's a long time. I think the principles still very much hold true in terms of how do you go about validating a problem? How do you go about validating and testing a solution? How do you move through the stages? We called them empathy, stickiness, virality, revenue, and scale. A venture studio, which is there to build and fund companies from zero, is really in that empathy, stickiness phase. So how do we measure if people are using this thing the way we want them to use it? Are they getting value from it? And so many of the principles back then, I think, still apply today. And most venture studios, Highline Beta included, has a reasonably rigorous methodology for validating stuff. And it's still based on lean principles. We've mixed some other things in there, like we do quite a bit of design thinking work. I really like DVF, which comes out of design thinking, which is desirability, viability, feasibility. And you sort of need a marriage of all three of those for something to really be successful. So you're stealing from other frameworks and processes, but a lot of these things they're just fundamentally true for how you go about building new companies.
Yeah. And I love that you point out that, Eric Ries's book, Lean Startup. So being very theoretical and yours being much more practical in a lot of different ways. I found that too, especially with there were so many graphs, there were so many charts. And there were things that as a founder, you can put on, your rosy goggles all the time and be like, oh, check mark, we've already done this. We've already done this. But if you actually break it down to be like, no, did you actually go from here to here? These are the numbers, these are the KPIs you should be following because this is your industry, this is your type of business model. Then you have to stop yourself and really ask those hard questions. And that is very different, other than, in comparison to those that are more theoretical, because it's so abstract. You can easily say that you have checked off all of these chapters when possibly you haven't. And I really liked having to be able to sit down and have these difficult conversations, with co-founders, and that all founders really should be having. Do you think that when startup and venture is being so glorified today, they are still having these difficult conversations?
Well, they're probably having them when they're running out of money and they don't have enough traction. So I would say yes. The short answer to that question is yes.
Right.
I think, I've been around long enough to see a number of hype cycles go up and then it comes down and then it goes back up again. So, I think yes, but sometimes you can raise a lot of capital, you can catch a wave, let's say AI agents, whatever it is today, it might be something else later on. You can catch that wave, raise a lot of capital, and not be completely intellectually honest with yourself about the progress you're making. 2020, 2021, a lot of capital was going into venture capital was going into startups. I would say that people were being less rigorous then about, do I really have traction? Am I really solving a problem that actually matters? Will somebody pay for this thing? I think we're in a bit of a more realistic phase right now. But again, there's always various hype cycles. So to me, the key is every founder has, out of necessity, a reality distortion field around them. Like they have to believe something. They're creating something net new. They have to protect themselves against reality, which is like, don't do this. It'll never work. Odds are you're going to fail, all of which is true. So you have to sort of believe so much in yourself and your vision that you keep chasing it. It's just a question of whether that reality distortion field gets so strong that you can't face any form of reality whatsoever. And that's usually when you sort of crash and burn and you're like,
Yeah.
oh, I didn't really know who the customer was, or I wasn't really solving a problem that actually mattered. Even though I've read that hundreds of times that I should do that, I wasn't really doing it here. So you need to be exuberant. You need to have this reality distortion field, but you need to also be intellectually honest at the same time.
And that is really tough. That's a tough pill to
Very
swallow.
tough.
I have also worked for those founders as well. So that is definitely really, really difficult. At the end of the day, sometimes you don't know if you are slowly succeeding as a founder or slowly failing in the startup because they both kind of feel the same.
Yeah.
And you don't really know if you're getting closer to that next milestone or not when you're kind of in the problem. And so I think that having a team around you, like Highline Beta, would really be helpful.
Yeah, no, I totally agree with that. I think sometimes it is hard to know. You've seen these graphs of very successful companies that look flat for years or
Yeah.
relatively flat for years, and then
Yeah.
there's some inflection point and they go up. It was an overnight success, even though it took 15 years. Like that, we know that that's how a lot of startups are actually operating. And so those first initial years can often look like that. There can be, you close a big deal and you think, that's it, we're off to the races. We've crushed it. We closed the first big deal, and then you don't close anything for 6 months. So it is a roller coaster. I think that's an under exaggeration of what it's really like to be a founder.
Yeah.
And so you can have these false starts. You can say, I think we're winning, but I'm not totally sure.
Yeah.
Honestly, I think most folks know they've won when they've actually won. Like that's just kind of like it's like, oh, we exited this business for a lot of money, or we
Yeah.
went public, and it's like, well, I guess that means we won,
Hmm.
and it's kind of hard to tell along the way.
No, absolutely. And, there are more founders now than there have been ever in the past, right? As more and more people are coming into this industry, and it's really great to see so many new things being built. In your opinion, what are the biggest kind of misconceptions when it comes to the concept of lean startup for founders?
Well, I think it comes down a little bit to this idea of if I just follow the steps, I must be winning. And so I think it's when we turn things like lean startup or lean analytics or any of these frameworks, jobs to be done, design thinking, when we turn them into a task list
Mhm.
and we say, okay, step one, do this. Okay, I did that. Step two, do this. Step three, and you're focused more on just getting the steps done as opposed to really evaluating whether you've accomplished something to
Right.
move from step one to two to three and so forth. I think that's what happens. So people will hear things like you have to talk to your customers. Okay. So they interview a couple of friends, their friends tell them that's a good idea, or they talk to their mom and their mom's like, well, I love you no matter what. That sounds great. I always thought you were a genius. And you're like, amazing. Like, check that off. I did that step. Now I can move to the next step. And so I think that's part of it. And then I think it's also just getting caught up in the hype of building a company and, um, the notion of celebrity that might come with that, the feeling of fame and fortune that's just around the corner. And so then we do the opposite, which is like, I know I'm supposed to do those things, but I can just skip those steps because I'm going to get to the good part. So I,
Right.
I think both of those are a problem. But with lean startup, it's really just like, oh, I'm going to follow this religiously,
Hmm.
and I'm at the end, I'm certainly going to win, but it's not a formula, right? It's not 1 + 1 = 2. That's not how these things work. And so to me, that's part of the challenge with getting too like becoming a zealot around a methodology is dangerous because you just spend too much time focusing on that as opposed to really analyzing what's going on.
Hmm. Absolutely. And I want to switch focus to ask you a bit more about the Venture Studio.
Sure.
So, Venture Studios have had hundreds of different kinds of models, and it's really, really difficult to find a formula that's going to work, right? You have to be very, very specific. You have to have certain kinds of experts or certain kinds of partnerships or those kinds of things. And you have personally seen, I've also personally seen a lot of them fail because they did not come from any expertise at all. And they just formed together with their friend from across the street. And they're like, let's start this. There seems to be a lot of money in the market. There seems to be a lot of startups that are happening. How can we capitalize on this? And that is putting more and more of a stain in the whole, thesis of what a venture studio should have been and everything. And so where do you think it's going to evolve to when there are so many models that were tested and failed before because of lack of expertise, because of the model that they put on founders that didn't work for the founders, and so on and so forth.
Yeah, venture studios are fascinating because they've been around a long time. They weren't always called venture studios. They might have been called something else, but the idea of trying to systematically build businesses has been around for a while. So, and now venture studios are kind of having a moment. I would say, an industry of sorts is emerging around them. People are talking about venture studios as an asset class,
Mhm.
trying to professionalize and mature the venture studio industry, perhaps. But
Yeah.
there are many models, many flavors of venture studios. So I think that's part of the challenge in doing that. So it's like anything people see it, they say, and they're opportunistic about it, and they say, "Oh, this thing seems to be getting a lot of buzz. Geez, I bet we can go do that, and be very successful. So let's jump in, close our eyes, jump into the deep end of the pool, and see what happens." And it turns out venture studios are really hard to
Yeah.
build.
Yeah.
Uh, their business model is not obvious. How you fundraise for them is not obvious because they have typically have a higher operating cost than a venture capital firm. It's not clear if you're always building venture fundable businesses or if you're building other types of businesses that aren't necessarily going to scale. So they're just complicated and messy. And so I think what happens like any industry, if we think of venture studios as an industry, as it gets mature, it starts to those that can't figure it out drop out of it and say, not for me.
Yeah.
Like and then those that are figuring it out, who are determined to make it work, stick around. So the bar goes up on
Yeah.
quality and expectations.
Right.
And the folks that are sort of tourists in the model move on to the next thing. And you see that in a lot of stuff, right? Just think of Web3 and crypto. There have been people in crypto for since day one.
Right.
NFTs was like a crazy hype cycle, and then most people got out of NFTs and went to the next thing and the next thing and the next thing. So I think it's just we're in that phase now. The hype is still there. I think the hype overall for studios is growing, but at the same time, uh, they need to generate returns and value. And so,
Hmm.
give it a couple more years. I think you'll see studios dropping off, more of them ultimately failing.
Yeah.
And the ones that do figure out, hopefully, are able to generate good returns for their investors, because that's really for most studios, that's the business is we can
Yeah.
generate better returns. That's the hypothesis. Generate better returns because of how we build these businesses.
Yeah, exactly. And because there are some which are either they take too much equity and therefore they're not fundable at Series A, B, C, etc. Just because they become a disqualifier for some of the growth stage VCs, or they have to restructure a lot of things, which is very, very unfortunate. How did you know what the right model and the right formula and the right negotiations were with your startups? And I also know that you came up with a great article where people were negotiating these kinds of contracts, and I'm like, I didn't know you can do that either. So that was
Oh,
very creative.
yeah. So I honestly, we're still trying to figure it out. I think we've iterated quite a bit over the last 8 years or so. I don't know if any one of our venture studio deals looks exactly the same, to
Okay.
be honest with you. So unlike an accelerator where it's,
Yeah, everyone's the same.
6% for 100K,
Yeah.
it's 3 months. I think ours have been sort of all over as we've figured it out. So I think my perspective on it is we're on the lower end of the equity
Oh, for sure.
take.
For sure.
Because again, we are trying to build, for the most part, venture scalable businesses. So we need somebody else at some point to pick up the ball and run with it and put more capital behind these businesses. So we are thoughtful and careful about cap tables to as much as we can be. Um, but we're still tweaking and iterating the model and trying to figure out what makes the most sense. Because again, studios have two things that they're providing really. One is capital,
Mhm.
which I believe, like if you're not doing capital, you're not a studio. So you have to be
I
investing.
agree.
Yeah, and then you have to provide some form of, let's call it service, right? You have to do work and you
Yes.
have to put in money.
Mhm.
And the balance between those things, though, is up for discussion. Are you putting
Yeah.
in $1 and putting in $100 of work, or are you putting in $100 and doing $1 of work, or
Yeah.
somewhere in between? So we're still iterating on that and figuring out where to position ourselves, how much work do we want to do? Because the work costs money, right?
Mhm.
Like that's the thing, right? Those
That's
are
true.
humans doing work, and we
Mhm.
pay those humans. So um, how much of that? How much capital? Um, what does the business model look like for it? So honestly, we're still iterating on it all the time.
Mhm.
But again, try to be on the lower end of the equity side because we do want to build scalable venture profile businesses, which
Yeah.
means we need VCs for the most part, or typically VCs to come in and fund these things after. Some VCs won't do venture studio deals ever. Some are, wishy-washy, like lukewarm, let's say. I don't, maybe
Yeah.
I'll do it, maybe I won't. And I think more and more are warming up to it if the cap tables and the structures actually make sense.
Yeah, yeah, exactly. Because, some VCs, we have to have a minimum X percentage of stake. And
Yeah.
if that goes beyond our check size, then numerically it can't work,
Yeah.
or, we need to have X and X as our co-investors as well. And they also need the same kind of percentage. And so that makes it really difficult. Or they have to make sure the founder has a certain percentage coming in.
Yeah. Yeah.
And that is also, it's tough either way because when you're a first-time founder, you don't know what's right or wrong. I have seen in my personal experience, and this is something I shared with you before, which was that, there were some that went into the studio and they came up with 5% each as a founder. And
Right.
I was like, but you're at pre-seed. You haven't even raised your pre-seed. What's
Yeah.
happening? And then the only thing they can do is restructure. So that, again, puts a bad name for the whole industry. And it's so interesting the way that you describe a venture studio is almost like you're describing an emerging VC fund. You have to have your win in order to regenerate your performance record and be able to have
100%.
your next cycle of funding. And you have to have your win to be able to prove out your models
Yeah.
and your thesis. And having experts on the team is very different than because that's a big advantage for the VCs is that they can have a whole bunch of scouts, a bunch of venture partners, a bunch of inflow. But because you need to have high level corporate partnerships and people to manage those and people with already deepened relationships, that part is tough because that's expensive to hire for.
Yeah.
And so having that balance must have been quite a journey for you.
Yeah. Yeah. And again, it still is. I don't think I don't think we've cracked the code on how to do this. I'm also not even sure there is a code, because if there was definitive formula for how to build companies, I feel like somebody else would have figured it out by now and replicated it to a point where they were so much more successful than everybody else that they
Right.
would be an insane outlier. So I think everybody's figuring it out all the time. We're always trying to balance the work we do with a founder on a startup, the capital we put in, and then that third element is the partners we can bring to the table. So
Yeah.
whether that's a corporate or a family office, or can we bring other investors to the table to co-invest with us
Mhm.
as something is leaving the studio?
Yeah.
So, to me, I've described that as like privileged access to stuff. And that to me is the key for a studio is
Yeah.
you have to bring stuff to the founder that they maybe could get on their own and probably could get on their own. It would just take them a lot longer and be difficult to do. So,
Yeah.
that's domain expertise, maybe it's capital, it's human resources to go to build things the right way. Um, it's network, it's all of the stuff that is supposed to genuinely accelerate something from the very beginning to getting out the door with early traction. That's the studio's job. After that, it's somebody else's job, right? Like the studio does not stick around forever in the process. Think of it as a temporary co-founder. But
Yeah.
but that's the job is over that first 6 to 9 months, can you bring privileged access to things that that founder needs that are going to help them get out the door faster, scale faster, win against competition faster, so that those do become fundable deals?
Yeah, no, absolutely. And when it comes to knowing if you are doing the right things, I think that one great way to show success is that your founders speak well of you and
Right.
that your founders are off able to raise other rounds and therefore you know that you have validation in the market because XYZ, these all these things came together, they had the right cap table that was accepted. They had the right product market fit that you helped them with and the right partnerships that are going to get that momentum that they were looking for, right? And so all of that put together creates such a positive relationship with founders that I do not see a lot of venture studios having just from my experiences. And they are also constantly in that fundraising mode, which is also very, very scary to see too, because as a founder, you want to know that you have that support that you were expecting and that you were looking for. You don't want to know that the venture studio fund is constantly then out fundraising again, and you can't find them, and they can't help you fundraise your next round, and they can't guide you. And so having these positive testimonials, I think, is a great first step.
Yeah, no,
Love that.
I agree. It's interesting that you say that. My co-founder, Marcus, says, our job is to earn the right on the cap table.
Oh,
That's our job. Now,
ooh, that is
you know,
not what VCs say, but that's
no, I know it's not. I know it's not. But at our stage, that's how we think about it. Now, again, all studios, there's lots of different flavors, right? So some studios will only incubate their own ideas.
right.
And so by
Oof.
virtue of that, you're automatically on the cap table because you're the only one on the cap table. So, and those are the ones that tend to take more equity
Right.
and bring in a founder who's more professional CEO, right? I'll give you 5 points because I've already validated it. Okay. Maybe I validated it and built it and got traction. Okay. Well, now I'm starting to understand that you've really taken this to a level where I can pick the ball up and run with it, which is different from I have an idea. I want 90%, you're only getting 10%. In our model, we do that type of incubation where we come up with our own ideas in areas we're interested in, but we also work with corporate partners and we validate ideas with them and then bring in a founder pretty early and get
Mm,
going. We also have founders coming to us with ideas.
okay.
And so we're more open-minded about where the original idea or opportunity comes from. We're less rigorous about that process where we say, no, we're only incubating our own stuff. We take it to this stage and then we recruit somebody.
Yeah.
We might have a founder on day one, in which case the cap table has to reflect not just that it was their idea, because in the end, who really cares where the idea came from,
Yeah.
but they're so passionate about it that you're really at the end of the day making a bet on the founder. Now you think through the studio that you can genuinely help that person get to the next step,
Mhm.
but at the end of the day, these things are only going to be no matter how much work a studio does. these things are only going to be successful if the founders make them successful, or the CEOs. Call them what you want, right? Like
Right.
I could be there for the first year. Like think of, well, pretty much anything. Like think of kids, so like I have older kids. Like you parent for a while and then you throw them into the world and you're like, all right, good luck. I did what I did. I made the mistakes I made. I did some things right. I did some things poorly. But now it's up to that person who is now an adult to go into the world and figure it out. I think of it the same way like a studio. Like we start these things with founders, but you know, I spend a year on it. If this is going to be a 10-year billion-dollar exit, that's not because of me. That's not because I started it 9 years ago, right? So the founder and the people you bring in are critical to the equation. That's again, like back to this idea of we have to earn the right on the cap table. If we're
Mm,
going to take 20 points, I want to earn those 20 points. And back to your point of like then having founders say, those guys were amazing to work with. They created tons
yeah.
of value. I don't go to bed at night wondering, did I get enough value from that venture studio? It's like, no, I know I did. And then when I talk to my downstream investors, when I'm going to raise more capital, and they say, geez, that Highline Beta, like they seem to own a lot. It's like, guys, we wouldn't be here if it wasn't for them. Okay, cool. Now, that doesn't guarantee success, but at least we were there to make sure this thing was stewarded successfully to get to that next level.
I think that's really well put. I love that. I love that line, and I love that humility. It shows that it's a really great founder-friendly approach.
It might be a little bit of the Canadian in us. I'm not
Yeah.
totally sure. Although I look, I've met VCs from all over, and I don't know if I've ever heard one say that, but I mean that could
I
be
have
tough.
never heard one say that. No, I don't, I think you're the
I'm
only
sure
one.
there are. I 100% know there are investors who think I need to earn the right on the cap table. So I know that that's true. Maybe they don't quite say it the same way, but again, I think of our model where we're taking a little bit more equity. The value exchange with a VC is very simple. Here's money. I take equity. I know there's value add that can be associated with that. There's brand recognition with top tier VCs. There's a whole bunch of legitimate value VCs can bring. But
Mhm.
at the end of the day, fundamentally, it's the money.
Yeah.
With the studio, it's a little bit fuzzier, right? So yes, there's the money piece of it,
Yeah.
but if it's only the money, it's not an awesome deal. So, and if it's just the service, it's also not an awesome deal for a founder because maybe you could scrounge that up in other ways. So it's the
Right.
combination of the two that is really important. But the
Yeah.
service part is always a bit nebulous. Are you building my MVP for me? Are you helping me get my first customers? Like, what are you actually doing? And it's not a menu of options, right? It's just like,
Yeah.
we're just going to roll up our sleeves and help.
Yeah.
So because of
Absolutely.
that, you have to think about how you're providing sufficient value to feel like you've done a good enough job again to get that company to the next level, earn the equity that you've earned,
Mhm.
and put that founder in a position to win.
Yeah. I have also like, I mean, there were a couple of interesting shifts from when I was a founder till now. And one of them being that when I was a founder, I saw this their Canadian venture studio. I don't think they exist anymore, but they had this like crazy way to negotiate against founders. I'm using the word correctly, which was like we start at 75%, and if you do these milestones, you get 25% back, and you end with 50%. And then on the flip side, I recently had a growth stage investor on my podcast, and she is amazing from Ridge Capital. And so she was talking about how, okay, well, no, we guarantee that we will do XYZ. If it's going to be opening up doors for you, if it's going to be a certain partnership that we know we have deep expertise in, we know that we are able to provide that for you. If we know that, it's going to be in the contract.
Okay.
We will do this work for you, and therefore we will fight for you. And I was like, I was just walled. I didn't know how to respond to that. I'm like, I've never heard of that. Where
That's earning that's
when I was a
earning the
founder.
that's earning the right to be on the cap table. Like if you're putting it into an actual agreement that
Right.
says, here's $100 for X equity, and
Mhm.
we're also going to do ABC for you, and it's
Yeah.
actually in a
It's a
term sheet
win-win.
or into a closed financing agreement, that's that's cool. Like I can appreciate why a founder would look at that and say, "Well, that's what I need, and I need this partner, VC again or venture studio, along with me for this ride to help me be more successful." Again, like our job at a macro level is the same like a VC. We're there to return capital to our investors. It's
Mhm.
pretty simple. I mean, that part, doing it is hard, but that part is pretty simple. So now it's just like, what's the best way of doing that? How do we do that? How do we genuinely create value for these companies so they can get to the next stage, so they can raise more capital? Which then again, you're right, like that looks good for us when we say, oh, X% of our companies have raised follow on. But
Yeah,
really, the real win is not follow on. The real
yeah,
win is exits and cash
absolutely.
on cash returns. Like
Yeah,
that's what we're here to do.
yeah,
And so again, we're still figuring out the right model for the studio. We're always iterating, we're always testing things, but we stay laser focused on, can we move this company forward as quickly as possible so that there's a chance that there's an exit down the road that we had some impact on, which drives cash on cash returns to Highline Beta and to our investors.
yeah. No, this is fantastic. And I'm so happy that you got to share this so that, more founders and more other investors can understand lots of different creative models and be able to have these options for themselves that, again, I wish I had when I was a founder.
Yep.
So, thank you so much, Ben. I really appreciate your time and I appreciate you being here. And thank you, everyone, also for coming on to another episode of Unlocking Venture Capital. I'm here with Ben from Highline Beta.
Thanks, Sydney.